A room costs $89 on Tuesday. The same room costs $289 on Saturday. Same bed, same view, same hotel. Here's why that gap exists and why it's not a mistake. Hotels operate on a brutally simple feedback loop. They have a fixed number of rooms. A 200-room hotel has exactly 200 rooms, no more, no less. Unlike a restaurant that can add more tables or a retailer that can order more inventory, a hotel cannot manufacture capacity. Once tonight's 8 p.m. check-in passes, that empty room generates zero revenue forever. It's gone. This constraint shapes every pricing decision that follows. So hotels ask a different question. What fills rooms? Demand, but demand isn't constant. Wednesday in March looks nothing like Friday in July. Weekdays see business travelers, weekends see families. Summer sees peak leisure travel, winter sees near-empty corridors outside holidays. These seasonal swings are predictable, hotels have decades of data, and pricing responds accordingly. That's where occupancy rates enter the system. If a hotel averages 60% occupancy on Tuesdays, management knows roughly 120 rooms will sell at that rate. But if they drop the price, occupancy might climb to 80%. The question isn't what's fair, it's what price maximizes total revenue. A $150 room at 80% occupancy generates more cash than a $100 room at 60%. The math drives the behavior, but here's where competition tightens the loop. If Hotel A drops rates on a slow Tuesday, Hotel B across the street sees their occupancy fall. They drop rates too. Everyone drops rates. This race continues until occupancy stabilizes at some new equilibrium, usually lower profit margins all around. So hotels developed yield management. They monitor competitor pricing in real time and adjust constantly. Events amplify this dynamic. A conference arrives in town. Suddenly 500 rooms that would have sat empty at $110 can command $400. Why? Because organizers have already booked flights and committed attendees. Price elasticity collapses. The hotel captures that inelastic demand. Locals notice the spike and blame price gouging. But from the hotel system view, they are simply pricing to match available demand, because tomorrow, that demand evaporates. Holidays follow the same pattern but with more certainty. Christmas, Thanksgiving, spring break, these dates are known years in advance. Hotels raise rates months ahead because they know demand will be inelastic. Parents aren't shopping for the cheapest room, they're booking a family trip. Occupancy locks in at 95% plus. Rates rise accordingly. It's predictable, systematic, and built into the business model. So when you see that $89 Tuesday versus $289 Saturday, you're watching a rational system respond to fixed capacity and variable demand. The hotel isn't randomly inflating prices. It's filling rooms to maximize revenue because empty rooms are the only truly wasted asset in the business. Once you see the feedback loop, fixed supply, predictable demand cycles, real-time competition, the pricing stops looking arbitrary. It looks inevitable. This video is for educational and informational purposes only and is not financial advice. Always do your own research. Subscribe for weekly deep dives into the economic systems hiding behind everyday prices, the patterns that, once you see them, become impossible to unsee. This video is for educational and informational purposes only and is